Is Bitcoin a bad investment?
Brian, I'm really excited about this show, but not nearly as excited, I think, as the audience is, because I feel like if you check out any of the comments on any of our stuff, or if you're just out there in cyberspace over the last, I don't know, year, 2 years, 3 years, it seems like Bitcoin is all the rage. So certainly they're waiting for some investment professionals, some financial professionals to wade back into those waters.
Well, 2020. I mean, already a very active year with the pandemic, election, so forth, but it was also the year of Tesla and Bitcoin.
Tesla
because
and
this was
those are the two highlights in 2020.
From an Ahab, Captain Ahab, chasing the great white whale. I mean, it was the year
Those are the big ones.
1,000% returns on both of those holdings. So a lot of people have started asking us our opinions on it, and there are a few things. First of all, I want to pick on the content team. We come up with clickable titles, and I said, hey, let's talk about Bitcoin. It's all over the news. I've kind of have some new additional thoughts on it. And we started off, what was on my sheet is Bitcoin a bad investment? Okay. And then I noticed the teaser, is it a horrible investment? So I guess by committee, they determined horrible would be more clickable than bad.
They just click the red light and we start talking.
So here's what I also want to go a little deeper on, is that Bitcoin, for all the things I'm about to discuss, there's still a lot of craziness going on. Matter of fact, on our channel, we have it all the time where it'll say the Money Guy Show, and then usually have some Bitcoin.
Some advertisement. Call this number.
You guys know, and I think a lot of you call it out very quickly because they don't realize you're dealing with financial mutants. We would never, ever, ever try to get you to buy Bitcoin through some link or give you a
promote
WhatsApp
something like that in the comments.
So here's what always pay attention to, because we're now officially verified. Another benefit to us being over 100,000 subscribers. Yep. So if you don't see the check next to a Money Guy comment, it's not really us. So be very careful, especially when somebody's asking you to buy something like Bitcoin. So I wanted to jump into this. First, I think it's worth doing a review on pricing. Let's talk about the last 12 months specifically for Bitcoin.
Yeah, you said in 2020 it was kind of the hot topic. Well, why was it the hot topic? If you look at the image on the screen right now, you can see that it went from, what's that, probably somewhere around like 7,000.
Well, but it went below 5,000. I mean, if you look around right as the pandemic was starting to pick up speed, I mean, it went down. I think the 52-week was right around 4,500 or somewhere in that range.
And then it's gone as high as above 40,000. Which is really sort of remarkable when you think in a 12-month window, that wild undulation in price. So 2020 has been remarkable just from a price movement standpoint in the value of Bitcoin.
So I always ask myself when I see a chart like this, well, have we been here before? And then so all we have to do is go to now the 5-year window. And you'll notice now, look, it didn't go as high because we have now crossed 40,000. But look at what happened as we were approaching 2018. We crossed... Well, we got right up to 20,000 and went from pretty much nothing. And it was the same thing. It was a bonanza of the media covering, a lot of people talking about it. So, but things have changed. And I wanted to kind of talk about, because I even feel like my viewpoints have evolved slightly to where I'm not completely throwing cold water on it. Now I'm throwing more of lukewarm water. So now if you're in the shower of Bitcoin, my practical joke is not as painful as it was when I had ice cubes in the water. But it is, and just for those who are kind of new to what Bitcoin is, because it's probably likely you have a relative that's at Thanksgiving or Christmas and trying to get you excited about Bitcoin and cryptos, and trying to get you excited. Here's what is interesting about blockchain technology and the whole mining of this, is there will only ever be 21 million Bitcoin.
It's fixed. It's a finite number. That's all that is going to exist. They're not creating more. They're not doing more. They're not writing more. That's it.
Well, and think about the design of this was also kind of unique in the fact that it started in the early days. Mining was super simple. But as we've gotten deeper, we're currently at 18.6 million Bitcoin have been mined. And as we go deeper into the process, we're about 89% mined of Bitcoin. It gets harder. You're going to be able to mine less and less. It requires more CPU power and so forth. So it is one of those things where I think that's kind of interesting, the design. It was very easy in the beginning, but as they kind of counted on controlling the supply and creating the scarcity,
it's getting more and more difficult.
It is getting harder to get more. So that's a very interesting thing. I thought it was it's also interesting, and I'll talk about this a little deeper. 20% of that 18.6 million is lost or considered locked up or stranded.
Now, this was sort of mind-blowing to me. So of the 18.6 million, 20% of it is just out there that's like you can't get. Like I think about like treasure chest maybe, like like the pirate had the treasure and then it got lost. Now it's nowhere to be found. It's stranded. It's like on some deserted island. Even that concept to me just seems foreign, sort of crazy.
Well, in the beginning, we didn't have all the easier ways to administer the cryptos. I mean, you had to keep your encryption keys, and if you misplaced them, you're out of luck.
Yeah.
So that's why they do estimate that approximately 20% are kind of stranded or lost Bitcoins out there. So I felt like, look, I told you my viewpoints have evolved. Let's talk about the positives, and then we'll talk about the negatives. So the positives, and I asked you guys, this was probably 6 months ago, we did a show where I said, I need you guys who are serious, because you're financial mutants that actually deal with cryptos. Give me the scoop. What am I missing? Build a bridge for me on so I can get there with you. And a lot of you guys really reached out. Now, I appreciated the dialogue. And here's what I recognize. For people who are in like economies, countries that they don't trust what's going on, this is an asset that holds value or perceives to hold value when the system can't be trusted.
Yeah, if you think that the financial system you're under could be drastically changed or drastically altered, here's a way to protect your wealth from that happening. And we've seen that in other countries across the world.
So we know that there's only a limited supply of this. Scarcity is automatically built into the design of it. So because there's a controlled amount, that automatically makes this somewhat an inflation hedge.
Sure.
Because if it's a holder of value and things are starting to run up in cost because of inflation, this will, just like gold, I mean, it is this generation's gold.
I've heard you say it over and over, that this is like this generation, where we're living now's version of what gold was maybe 20, 30 years ago.
Because it's the same thing, limited supply, and it's a holder of value, so that's something to consider. And here's a big breakthrough that's happened also, is that it's now more liquid now that you can invest through players like Robinhood Crypto.
Yep.
It's not exactly Robinhood, their investment account, but they do have a branch that's the crypto side, which makes it easy. You can trade, buy, and sell Bitcoin now completely free, which is awesome. And then I think it's also a big breakthrough. I know PayPal has announced that 2021 is the year that they plan on integrating cryptos into their platform. So that's a big win for anybody who's out there in the Bitcoin craze that's currently going on.
What I'm hearing you say is not only, like, obviously the price would suggest this when you think about like supply and demand terms, but it's becoming more popular. It's becoming more commonplace. It's becoming more prevalent. It used to be sort of this thing that kind of existed out on unique blogs or out, sort of on the periphery. Now it is becoming more of a thing that we're seeing more regular on a more regular basis.
So now that I've built it up, let's talk about the concerns I have. The first thing, it's still going to be super volatile. If you, and I don't mind disclosing, I don't own any Bitcoin.
Yep.
It's just one of those things. I don't own rental properties either, so it's not that don't read too much into that. But it is just It's not something that I'm intrigued with. It's not something that I've bought for clients' portfolios, because it is very volatile, very speculative, and that's what I want to make sure I clarify this. Investing is different than speculating.
Yep.
Doesn't mean you won't make money speculating, but it is just a different mindset, because if you think about when you're investing, you might be wrong on the time, but it doesn't. There's still something of value there.
Right.
Where, remember, companies can always innovate. They can have income streams. That's not going to happen with cryptos, and not even going to happen with gold. Like I said, this is this generation's gold. The only way you make more money with Bitcoin is if somebody out there is willing to pay you more than you paid for it.
Yep.
Because it's not going to pay you an interest, it's not going to pay you any dividends, and it's not going to innovate. It's just going to be a holder of value that you have to convince the next person to buy more of.
That second part you said is what resonates with me so much, is that there's nothing that I can do inherently. There's nothing really that anyone else can do to make it more valuable. The only thing that makes it more valuable is the next person willing to purchase it is willing to pay more. that makes me nervous because it seems so out of my control in terms of what happens with the fluctuation of that. Like you said, it's not innovation. There's no income. There's nothing changing about it except for the public perception of it.
The other thing, and this is kind of evolving too, regulation. Now, we talked about this in the content meeting because we had it written a different way. And I said, look, I think regulation is kind of a double-edged sword that's right now Bitcoin and all the cryptos are sitting on. And the fact that it could, we still run the risk that the government just decides they don't like this and they regulate away your ability to have full access. Now, but regulation also could be the bridge that makes this more of a household thing. I just know regulation right now in my eyes, because it's still in the taking shape phase. It could either build it up or it could crush it. I think it's too uncertain right now to really know either way where that's going. And the other part is, and there's been a ton of viral messages about this or posts about it, is that the design of cryptos also creates this weird quandary because there's no central administrator. We all lose our password. Just go hit the reset password button because, Vanguard, Fidelity, whoever will send you a new passcode. They'll find some secure way to let you reset it. There is no central administrator with cryptos. So you lose your encryption keys, you're probably out of luck. And we've seen that because we've all seen it. There's some article out there where the gentleman has access to hundreds of millions of dollars, but he only has 2 more password attempts.
10 attempts, and he's already used 8 of them, and so he lays in bed at night trying to think about what his password was.
So, I mean, that type of stuff. And then here's the other thing. Like right now, and I thought this was interesting, Daniel found this out for me, Charles Schwab will now let you do cryptos in Charles Schwab accounts. Fidelity, Vanguard, some of these bigger investment firms still don't let you do it. So it's not like you can go buy in your Roth 401k, your Roth IRA, Bitcoin if you're at Fidelity Investments. So it's something that whole lack of central administrator, lack of regulation really has kept some players, they've kind of been very weary of jumping headfirst into this thing.
And so it sounds like we're kind of playing on this line, Brian. I'm not hearing you say, oh, yes, you should invest in Bitcoin, or oh, no, you should not invest in Bitcoin. So if I'm a listener out there and I'm thinking about this, okay, I'm interested, I'm intrigued, I want to maybe participate in this. Do we have some thoughts on, okay, does it make sense? When does it make sense? How does it make sense?
Well, first, because this is the part for young listeners out there, because I know it's easy. You've heard it. We all have a friend who, especially if you're younger, who's probably turned $500 into $5,000 at this point. And you're like, that could have been me. Well, maybe. This should not be your first investment. This is the biggest thing. I think whenever you start investing, remember, investing is different than speculating. I want you to cast a wide net. There's nothing wrong. I love fishing. There is something really cool about fishing. You go buy the lure, you go put your, you got your rod and reel and you choose closed face, open face, you're just doing the Zebco. But all those things, and it's so cool to go fishing, but you're not feeding your family every night by going out there with that one lure. A commercial fisherman throws nets in the water. And that's what I always tell people. When you're starting out investing, I want you to put a net in the water. And that's buying index funds, buying low-cost things, because that's actually investing. You're basically buying your piece of the growing economy, the growing, ever-evolving innovation that we're all part of in this modern world. You might get lucky and have the Captain Ahab moment with Bitcoin, but it is speculating, so this should not be the first thing. Where I think this fits in is that a person who has worked through, and once again, we talk about the financial order of operations, this is the cherry on the top of your sundae after you've gone through the basics. You don't start at Bitcoin unless it is the same amount of money that you're planning on speculating to throw away, 1%, 2%, 3% at most. But this is not what you're trying to fund on your monthly systematic savings plan. I just think that it's way too volatile, way too speculative to be playing in that aspect. This is more of something for your fun money than it is to be the foundation of your financial resources.
Yeah, it reminded me, and now I'm going to share the analogy I shared in the show prep meeting, because I don't know if this is perfect. We are going to be the first to say we don't know what's going to happen with Bitcoin. We don't exactly know where it's going to go. We don't know how it is going to change or not change the world. But it reminds me, When I was a young child, I went to an amusement park for the first time, and they had this ice cream at the amusement park called Dippin Dots. You know Dippin Dots? And I remember I was old enough to read, and the tagline said, Dippin Dots, the ice cream of the future. And I remember I ate it, and it was like these little balls, and it was amazing. And I was like, as a little kid, I was like, this is so much better than any ice cream I've ever had. This is the future, and the tagline says it. Everyone has told me this is the ice cream of the future. Well, I was young, and I went and rode rides, and I forgot about it. And then, I don't know, a couple years ago or a couple months ago, I don't know, I was at a mall, and I saw a little Dippin' Dot stand. I was like, man, that's incredible. There's Dippin' Dots, and it said, ice cream of the future. And I was like, huh, this thing has been the ice cream of the future for the last, 30 years.
Right.
That's not to say that it wasn't a good thing, and it's not still around, but for Dippin' Dots specifically, it didn't change the world. It didn't replace all of the ice creams out there. I don't know if Bitcoin is going to be that thing or not going to be that thing, but that's what it makes me think of. People that are so certain. Everyone says, oh, if you're not putting everything you have in Bitcoin right now, you just don't understand crypto. That's a bridge too far for me right now with where it's at.
I challenged you a little bit in our content meeting because you made that analogy. I loved it. I said, but let me challenge you. I said, because look, Bitcoin is becoming more accepted. Now that you can do Robinhood, now that PayPal's integrating it into its platform, and you actually had a pretty witty comeback. What was your comment on that?
You can go buy Dippin' Dots like Kroger or Publix. You can go find it.
It used to be something only at amusement parks and unique. Now it's at Kroger.
You can go get it. Yep.
It still doesn't mean that it's replacing money.
It's not changing. It didn't change ice cream. So Bitcoin, maybe it will, but I am not willing to sign on the line and say, no, this is going to be the thing that changes the world. I think it's still too early. We just don't know yet.
Here's my closing statement is that I have softened on the whole crypto thing, so I don't sound like the old man on the front porch yelling at the kids on the lawn with the Bitcoin. But it is still one of those things where this should be the speculative, the play side of your investment portfolio, not the base level or foundation of your investments. Be very aware of that because I think it's going to remain very volatile, very speculative for quite a period of time. So, but it's something to keep a watch of. I mean, I love, as you've gotten to know more about the design, it's fascinating.
It is
this whole thing with mining being easy in the beginning, harder later, the set number at 21 million, just really some brilliant minds went into the design of this. So you can't help but be fascinated with that part of it.
So you guys know this. Every other Tuesday, we like to hang out with you guys. We like to answer your questions because ultimately what we want to do here is perpetrate the abundance cycle so you guys can learn and grow and take your finances to the next level. So with that, I think we got to answer some questions. How do you feel about that? You ready
let's hit them.
All right, this first one is from Dan O'Halloran. Hey, can you speak to donor-advised funds? I want to become more organized about my giving this year. I think that's a great goal in 2021. What are your thoughts? Is it beneficial to the charities I support and not just myself? So maybe what is a donor-advised fund? How does it work? And is it only good for me or is it good for the charity as well? And then I'll kind of sprinkle in some benefits.
I love donor-advised funds. I think that if you are charitably minded, this is the way to supercharge your generosity. And it is, by the way, a win-win situation for both you as well as the charity. And let me explain kind of how these things work. A little history lesson. Back in the past, if you wanted to give appreciated holdings to a charity, you had to go through a lot of steps, meaning that first you had to convince your charity, go open up a brokerage account with one of the big wirehouses, and then you could give primarily only appreciated stock. So if you owned stock of a company that was traded, you could give that appreciated company and donate it by transferring it to the brokerage account of the charity.
Yeah.
We've gone, once again, innovation, technology, and just the modern world we live has made everything so much better, so much easier. Because a lot of us, I always used to think about the fact, I don't do a lot of individual stocks. I'm more of a mutual fund investor. What do I do?
Yeah.
And then I don't want to go ask my local church or my local, charity for the animals that I care for. I don't want them to feel like they have to go open a brokerage account just so I get a tax benefit. It's gotten so much better because now what has happened with these donor-advised funds, and the ones we're very familiar with is like Fidelity Investments has one, Charles Schwab has one. You can donate mutual funds. You can donate anything pretty much that's in these accounts that's appreciated. And here's the cool thing for the charities. They absolutely do not have to open any accounts. Now they just get checks.
They get a check.
I mean, they just get a check, no different than if you were writing a check with a checkbook. But here's why it's a win-win for everybody involved. When you have appreciated holdings, you know it, and I'm going to give a simple investment. Let's just say that you bought Tesla a year and a half ago. And I mean, seriously,
No,
you
it's
bought
a
it.
big one.
You know,
I
you
thought you were gonna
paid
go much more simple than
you
that.
paid $100 for it. It's now worth $1,000.
Sure.
You've decided you want to be charitably minded and give that $1,000 of Tesla stock to your donor advised fund. What's great is that you've got $900 of capital gain that you don't want to pay income tax on. Well, so you donate it to the donor advised fund. You don't pay any income tax. You just donated $1,000, $900 of appreciation that's never going to be taxed. You're going to get a charitable contribution of a full $1,000,
yep.
not $100, not what you paid, as long as it was 12 months of holdings. It's got to be long term, by the way. You're going to get a credit for $1,000. The donor advised fund is going to sell that Tesla stock and then send a check. If you go in there and say, hey, I want this to go to my church, I want this to go to my animal charity, you will automatically, they will then send a check for $1,000. That's going to be no different than you stroking them a check, but now you get the charitable deduction, plus you didn't ever pay the capital gain tax. It's a win-win, and they get the money.
Can I tell you two things that I love about donor advised funds? It makes the process, in my opinion, of giving a lot more easy and streamlined. I know that I used to, I'd have a nephew that wanted me to donate to something, and then I'd have this cause over here. And through the course of the year, I'd have, 50s and hundreds and all these things all over the place. And then when it come tax time, I'd be like, oh man, I got to go remember all the things that I did, or I had to put them in a shoebox. The beautiful thing when it comes to filing your taxes is when you have a donor advised fund, rather than having to go collect all those receipts, you only have to keep up with one number. How much did I put into the fund? So even if you made a one-time contribution of $1,000, but you had it go in $100 to 10 different organizations, from a tax standpoint, all you care about is that one contribution of the $1,000. It just makes tax filing a whole lot more simple. And the other thing that I think is great is now you can even set up recurring donations. So even if you are someone who wants to give to a church on a monthly or weekly basis, you can actually have your donor advised fund set up to do that automatically. So it just makes that process a whole lot easier, a whole lot more streamlined. It makes tax time at least just a little bit less stressful.
One quick statement on kind of a tax hack that I do. If you are charitably minded every year, it's not just a one-time thing because you had one appreciated holding. Like if you're a tither to your church, there is another level that I'd like people to understand. And this is something I practice personally, is that one of the problems when you start investing in after-tax money is you're going to notice when you're successful at it is that, yes, you have this after-tax account that you're kind of earmarked for your future, for retirement, but it's kind of hard to get access to the money because it's now getting to be too appreciated. Anytime you touch that money, you're going to pay income taxes on it. Here's what I like, is that I give every month to my church, but I'm doing that through the charitable advised fund, but then every month I'm replacing by buying. I'm dollar cost averaging into the same investments that I'm now donating, and it's replenishing. And guess what it's doing? When I'm getting rid of the lower basis holdings and rebuying at the higher price, I'm slowly raising the basis in my taxable account. So it actually creates a fourth benefit of is that I actually get easier access to my after-tax investments if I ever so needed to get into that account.
That's a great point.
So that's kind of extra level. That's advanced planning, but it's something if you're charitably minded. And by the way, this is probably a last plug on the abundance cycle with that is that if you get into those advanced things and you just want to nerd out on best ways to do it, that's when it probably might want to have somebody like a financial planner that can work through some of those charitable goals in an advanced stage so that you make sure that you're taking care of everything and there's not any blind spots to the plan.
Love it. All right, this next question, this is a funny one because I think that there's a Brian Preston in here. I think so. This is from Buffer Monster. That's an interesting name your parents gave you. It says, is it a good idea to apply for a credit card before or after purchasing a vehicle? So I'm going to build a bridge here. I think that this person wants to go buy a vehicle, probably going to have to take a loan out. So his question is, hey, should I apply for a credit card before I do that loan or after I do that loan, and what are the implications?
Well, Buffer, I mean, because I think that there's a broader question here is when should you apply for a credit card?
Sure.
I mean, because that's kind of, and I'll let you throw the color in because this is a personal share, is that I was raised, everybody knows, because I've talked about it on the show a lot, don't come from money, but I come from very frugal parents.
Yep.
So my parents were good at saving, they didn't understand this whole thing. There was this whole other world of investing. So, because investing to them was CDs and cash and just having cash in the bank. So I was also always told debt is very dangerous. Be very scared of it. Stay away from credit cards. So here's the situation I got myself into is that I came out of college without debt, and which is odd because every friend I knew in college, because back then they were giving out potato chips. If you just go sign up for a credit card, you'd see this huge line on campus with bags of Lay's potato chips, and people were signing up for credit cards so you can get these 88-cent bags of potato chips. That's how simple it was back then, is because credit card companies will easily give credit to college kids. It's twofold. They know that you're in college, there's potential of earning potential in the future. And then the second thing is they know most kids in college have mommies and daddies that will pay that credit card bill off when they run wild and run up $1,500 within the first 2 months that they have this credit card. Well, I was raised in a house where I was scared to death of it, didn't do it, went to go buy my first car after college, had no credit history, had the letter from the CPA firm that was hiring me, and the bank was like, sir, you have no credit. So we're not giving you a loan.
We have no idea if you're a good borrower or a bad borrower.
Yeah,
you're just
you
not
have
a borrower.
zero credit history, so we're not going to sell you. We're not going to finance you on this car. So, but here's what I'm telling you: you got to self-advocate, and this is what you knew the story here. And but you've got to self-advocate, and it's probably harder dealing with online banks as it was back then when this was actually at a South Trust, which is now part of the Wachovia family. I went back. I left. Got mad because I didn't want my parents to co-sign on a loan. I mean, I'm a college graduate now. I got my first real job. Heck no,
I can do it on my own.
I'm not going to ask my parents to co-sign. Went back and talked to the branch manager, and I said, look, once again, this is my letter to a CPA firm. I will never, ever, ever use this bank, do a mortgage through this bank. I will not, any success I have in the future, you will be cut off from because of this one decision. I would ask you once again, please go consider the opportunity to work with me and loan me this money. Called me back 45 minutes later and said, Mr. Preston, we will give you that loan. So you can advocate. I think that's harder sometimes with the other stuff, but it does answer the question in the fact with this experience share is that, yeah, you probably ought to try to build up a little credit. If you think you're going to finance a car, I always tell people now while you're in college, while they're giving away credit so easily, I'm okay with you getting that first credit card. I actually think it's probably a smart move to get the first credit card. That doesn't mean you're using it a lot. That doesn't mean you're trying to do like all my friends did where you run up your $1,500 to $2,000 limit as fast as you possibly can. But it does mean you are starting to build some type of credit history so the banking system at least knows who you are. Because remember, it's not just car loans. It's also what you'll pay on your insurance rates, on your cars, on your homes, whenever you start buying houses. There are some benefits to having good credit ratings.
This is what I love about the way that your mind works is you went a completely different direction with that question. And you're exactly right. I was thinking something completely different. I was thinking he was asking about like order of operations, like I'm going to open up another credit card. Do I do it before my auto purchase or after my auto purchase? But you were talking about establishing credit history, what I think is great. I'm going to tag on my other thing, which I think is maybe a different question than he was even asking, but I think it's important because one of the things we always do is like whenever we make big purchases, we buy a house or we buy a car, we need to have a loan. One of the things that they're going to go do is they're going to go pull your credit history to see how good your credit is. That's exactly what you said. You have to like establish it early on. Well, one of the things you want to be careful of is if you are going to go apply for a new type of credit, like a home or like an automobile, you probably don't want to open up a credit card or a bunch of credit cards immediately before doing that. Or like if you're going to buy a house, you don't want to think about, I got to furnish the house. So I'm going to go get a bunch of store lines of credit before you finalize the loan because all that stuff is going to show up on the credit report that they pull. So if you are buying a car in the very near future and you already have some credit history established, I'd probably wait until after that car is purchased to then go open up the credit card so that it doesn't affect the interest rate you're going to pay in the car if you're financing the car.
That is a great point. And I do have an experience share on that too. My first house purchase. You get so excited you want to go buy furniture for it. Well, when you go to check out at the furniture store, they say, hey, Mr. Preston, you're buying enough here that will give you, why don't you open up a store credit card, save 10%.
You're like, oh, 10% discount.
10% discount. And since this was a few $1,000s, I was like, oh my goodness, that's hundreds of dollars. Of course I should open up a store credit to save the 10%.
I'd be crazy not to do that.
Guess what? That one decision cost me a little bit. I paid a higher percentage rate on my first mortgage because of that knuckleheaded move. So Bo is spot on. If you have any big purchase coming up, you do not want to have a lot of debt inquiries in there. So do not. Remember, debt is one of those things. If you're using it, be very scared. Be scared. Treat it like a chainsaw because debt is very scary. So you should not be doing willy-nilly a lot of credit inquiries at once. So great plan. I'm glad. This is why we're a great team.
I love it.
We work it from all angles.
This next question, let's stay on that sort of debt idea because this has come from SC Marbell. And we get this all the time, again, because you guys are financial mutants. And this is a question that's not black and white. There's some gray, and I think we'll share what the gray is. It says, how should 0% financing rates, available now from many dealers, factor into your car buying recommendations? I can pay cash, but it's hard to do it with 0% interest. How long should I carry out those payments? And we get this all the time, and it's not just 0%. We get it when it's 0.9% or 1.9%. How should I go about taking advantage of really low interest rates if I'm in the position to do either or?
Well, first, I mean, and we've talked about this, but I think it's worth repeating. The 23-8 rules we have with car loans, just to review really quickly. Remember, we think with any type of auto purchase, first of all, it can't be a luxury brand. If it's a luxury brand, it's 12 months, same as cash. So you got to make it through the gauntlet of that first. Once you know you're buying a non-luxury brand, this is more of a practical car. We're okay with financing as long as it's 20% down, you don't amortize longer than 3 years, and it's not more than 8% of your gross income. And then there's one other caveat. Your investments have to exceed, your monthly investments have to exceed what your monthly car payment is. If you get that backwards, you go really screw this thing up. So with those type of understandings, I get it. You especially because Bo and I just had this conversation recently. Like Honda is doing, I think, like 0% for 5 years. Yeah. So it's like, wow, I could really. There's an arbitrage situation I could potentially take advantage of. But here's the problem that always grounds me on vehicles. Vehicles are horrible for your balance sheet, your net worth statement because they depreciate like a rock. So even if you're getting 0%. In the background, you can practically hear it. If you get quiet late at night, you can hear the loss of value just running out. It's like a cash register just quickly running. You hear cha-ching, cha-ching, cha-ching. That's the money just dumping out of the exhaust pipe of your car on how fast it loses its value. Because that's going on, that's why we do 36 months on the amortization. You can look, I'm not going to tell you, you can take a 60-month loan with Honda at 0%, but you need to pay that car off within the 3 years because it's depreciating, and I think it's just a good practice. Plus, it will also keep you honest from buying more car than you can actually afford with your wallet because I think sometimes that's the game that dealerships have figured out is that when America is focused on the payment, not the actual total debt, we got a solution for that. We'll just extend this thing out to 6 years, 7 years, and we'll get your payment down to whatever you want it to. You'll just never actually own this car while it's still depreciating like a rock in your driveway. Don't fall victim to that. Get out of debt, and it'll also keep you, like I said, honest on what you can actually afford when it comes to cars.
Yeah, I think one part of the 23-8 that we don't often talk about as much that doesn't get enough focus is the 20% part. You got to put 20% down. Well, here's the real reason. In our opinion, one of the biggest risks you can run if you're going to own an automobile and you're going to finance it is becoming underwater on that auto, meaning that you owe more than the car is actually worth because you may be the best driver in the whole entire world. But even if that happens and your car gets totaled, right? So an accident happens, your car gets totaled. The insurance company says, okay, great. Hey, we're going to pay you this much for the car. You're going to get a check for $10,000. And you're like, oh, okay, great. But when you have a loan that's outstanding for like $14,000, you start thinking, oh, man, not only do I have to go get a new car, I got to satisfy that loan that I have outstanding. You always want to make sure if you are financing a car, And even though if you're doing it over that 3 years, you should know about how much that car is depreciating over that 3-year period and make sure that you always stay above loan value on the equity that you have in the car, meaning what it would be totaled for or what you could trade it in for.
Now, comment section, a lot of people have said, what about gap insurance? I mean, what are your thoughts on gap insurance? Because that's what I hear. We've even had people mention that in our comment section.
In my opinion, I don't think that gap insurance makes a whole lot of sense because I think if you have the appropriate equity in the car, then you don't really run into that issue.
Yeah, why pay for something you don't need?
Why pay for something that you don't need if you're doing it the right way following 23.8?
This is not the arbitrage situation that houses have. A lot of people know that we have a different take on if you're under 45 years of age, those low interest mortgages versus investing. The difference is your house is not depreciating at 50% in the first, 3 to 4 years of ownership, and that 50% depreciation should scare the heck out of you, and you need to stay above because remember, your whole goal is wealth building, not wealth losing.
That's right.
And automobiles are wealth losing behaviors. Treat them as such.
Love it. All right, this next question is from Nick Stevens. Nick says, if your Roth 401k has no fees, but your Roth IRA has a 5.75% transaction fee and $10 yearly fee, would you still take match and max out Roth or put it all in the Roth 401k? So I'm going to start on this one. If your Roth IRA has a 5.75% transaction fee and a $10 yearly fee, you should change where you house your Roth IRA. You should go look.
I have a clue where that Roth IRA is, by the way.
I would go look
somewhere. When I hear 5.75%, I know exactly the A-share class you're buying.
I would think about going.
There's probably 4 funds that they got you invested in, but I'll stop there.
I would go look at a Vanguard, a Fidelity, a Charles Schwab, a Philip, like a low-cost custodian, because you do not have to pay 5.75% on your Roth IRA. You do not have to pay an annual fee on your Roth IRA. There are free solutions for you out there, and you get to choose where your Roth IRA is housed. So step number 1, I'd stop doing that because that just does not make a lot of sense for what you're doing. Well, then the question becomes, if I have access to a Roth 401k or an access to a Roth IRA, should I just put everything in the 401k or should I get up to the employer match in the 401k and then double back to the Roth IRA?
That's a great question, and my brain was going in a bunch of different directions when I'm thinking about because here's the ideal, and I'm going to. Before you start sending me the troll comments, I get it. Remember, we're financial mutants. We're for the 20%, not the 100%. So when I give advice like this, I know this is not everybody because this was not even Brian Preston when I was 26, 28 years old, is that the goal is I'd love for you to be able to do both. I'd love for you to be able to max out the Roth IRA, the Roth 401k if your income was below the thresholds. But I think for a younger person, that you're not at the level where if you're trying to get to your 20 to 25% gross income savings for the future retirement. And I'd love to get your take too, Bo. I'm okay if you do, especially in this situation where you have a Roth IRA and then a very low cost because maybe you have an employer that has a very low cost plan with Vanguard or Fidelity. I'm okay with loading up the Roth 401k. Because, look, there's also some ERISA protection.
Sure.
There's some good things, but I think it becomes more of a line in the sand moment when you get higher in income and you have the ability to actually do both. And now you have to also think about, well, which tax bracket am I in? And can I do a backdoor conversion strategy? It gets a lot more sophisticated and complicated at that point, and that's where the financial order of operations will hopefully clarify it.
I think it's really close. My advice would be I'm going to start with my Roth 401k. I'm going to go get the maximum employer match. And then, because I'm using a low-cost provider like a Fidelity, like a Vanguard, like a Charles Schwab, I'm going to go max out my Roth IRA up to the $6,000 or $7,000 a year. And then, once I've done that, I'm going to go back to my Roth 401k.
Yeah.
The only reason I'm doing that cutout for the Roth IRA is really for one main benefit. Inside of a Roth IRA, you can always get to the money that you put into it.
Good point.
Without having to pay taxes or penalties. Now, you never want to do that. That's like break glass in case of emergency, but you can get to your basis. Well, if it's held in an outside IRA, it's much easier to get to that. Your 401k may be structured where if you're still working, if you're still an active participant, you actually can't go get to those dollars unless the plan allows for in-service withdrawals or that sort of thing. So in my opinion, the Roth IRA provides just a slight bit of additional flexibility outside of the 401k. So I would do 401k to match, then I would go to Roth, and then I would go back to maxing out the Roth 401k.
This is a unique case, the way this was presented, in the fact that low-cost 401k option, high-cost Roth IRA. That's unusual
That's
by the
very
fact
unusual.
because, especially if you're watching the Money Guy show, you know that is optional to have the high-cost Roth. Whereas a lot of times with the employer plan, your 401k, you, the employee, don't have control over that. And it's not uncommon that we have a lot of 401ks that are expensive, that might have that 5.75% commission built in or higher operating expenses, whereas you can personally go choose a Roth IRA with the low-cost providers like Fidelity Investments or Vanguard and keep those costs low. So I think you're spot on, Bo. And that, well done on the essentially closeted emergency reserves fund.
Last reserve.
That is one of those things. I don't want you to ever break that glass, but when you get desperate, you get in a bad situation like we had in 2020 where maybe you lost your job and you have all these things going on, you want to have access.
You got to do, yep. All right, this next question is from Daniel S. This is, my wife and I are newlyweds. Congratulations. We have combined finances, but I'm curious about what to do with our individual taxable accounts. So it sounds like they came into the marriage and they had their own individual accounts. Should we start a joint account or should we keep contributing to our individual accounts?
Yeah, now look, I'm a guy that loves the thought of a joint account because it's one of those things. Even when I've been married, wow, I just blanked because it's 23. I think 23 years. I mean, so it's one of those things where I have seen couples that do everything separately, and I've seen couples that do it joint, and I like the joint because I never want my wife to feel like. I don't like the discussion of who makes the money.
Sure.
Because I think that creates some weird dynamics in a relationship. But I'm going to tell you that, but then I'm going to give a caveat here. I think there is nothing wrong if both of you brought assets into the marriage. Like if my wife, when we got married 23 years ago, had an individual account that had a decent chunk of money, I'm okay if that money stays her individual account because let me tell you why. There's actually some legal protection to those assets. That was money she brought into the marriage, or if I'd brought it in, it was money I brought in. There's a legal protection that money is not considered joint or marital assets at that point. So if there was ever something bad that happened, it's protected. But I do think once you're married, why not open up a joint account, start that systematic savings plan as a couple, because then that's going to lead to even cooler stuff. Like I talk about one of my favorite date nights with my wife is when we go out and just do our travel journal of where we think we want to go. We kind of daydream on where we want to travel for the next 3 to 5 years, or we'll do like it was probably in the last few weeks that Jennifer and I went over the net worth statement together. And that is just such a fun exercise when you're treating this as a household endeavor, as you and your spouse together versus everything kind of being separated out.
Now, I agree with you. I feel the exact same way. In my house, with my wife and I, everything is joint accounts. However, we do work with clients all over the country from all different walks of lives and first marriages, second marriages, all that sort of thing. And we've seen it be very successful where folks have their individual, investment accounts. But here's where I would draw the line on that. If you're going to operate as a household, even if you're going to have individual assets, I don't believe that as a household you should have individual investment policies, investment strategies, because then you have two things that aren't working as efficiently together as they could be. And we see that sometimes where someone says, oh, well, I've been doing it this way with my accounts, and my spouse has been doing it this way with their accounts. There's a lot of change you're going to run into investment inefficiency in terms of your overall risk profile and tax inefficiency with how the accounts are working together. So even if you do opt to keep the accounts separate, you want to make sure that the accounts are working together with one another in conjunction to make sure that your plan is moving forward as efficiently and effectively as possible. And we've seen that happen. We've seen that work well.
Yeah, and I think your point also highlights the fact that, obviously, I told you guys I've been married since I was 23. I got married when I was 12. So, when you get married at that young of an age where you have absolutely nothing to your name, it's an easier decision.
Yeah.
Whereas I think we do have, because you brought up our clients, I'm thinking of a number of our clients, especially if you met later in life and maybe
Sure.
this is a second marriage, so the dynamics between families gets complicated. I mean, let's just face it, it is. I think there is nothing wrong with those assets might have to be individualized because life happened. There's a lot of things that have gone on. That doesn't mean once you're a couple, though, you don't keep those individual accounts out there separate, but you start building a new joint account since y'all are now a joined union.
Yep, I think that's great. Christopher, he's got a long last name.
Why do you do last names? We don't. I would just skip all last names. Save yourself the heartache.
All right, hey Christopher, one of the 400 Christophers of you out there.
Christopher will know his question.
Okay, here it is. He says, early 30s, current retirement contributions will hit FI number by 45. Awesome, that's great. Should I continue to up the retirement contributions or put more in a taxable account for early retirement? So he's in his early 30s, he's saving, he knows his number needs to hit, and he's currently on trajectory to hit that, but it sounds like he's not maxing out his retirement accounts. Should I do that? Or should I start funneling some money to a taxable account if I'm thinking about financial independence at age 45?
Yeah, I mean, I definitely think there's a lot to take in there, and that's why once again, go out to moneyguy.com/resources, and you can download our free financial order of operations. And this is something we cover in step 7, which is hyperaccumulation. Yep. Now, I will tell you, I think Chris ought to consider. Because I'm assuming if you're saving at that threshold, he's probably in a decent income situation.
Bracket, yeah.
And sometimes when you're in a higher income situation, the tax ramifications should come into play. So, and one of the most tax favored things out there is retirement savings. So I would first, if you're in a higher income situation, you probably do want to max out some of those retirement benefits just for the tax savings. But I think he is spot on, is that once you get to, especially if you think you're retiring at 45, 50, even 55, anybody really under 59 and a half, you're going to have to ask yourself, how do I get access to assets when I retire? Because you're going to find out you might be retirement rich, meaning you have lots of assets in tax-deferred accounts, but you don't have access to any liquidity to actually use right now. And that's why I do love the idea in hyperaccumulation where, yes, you start building up that third bucket of assets. Not only do you have your tax-free Roth, not only do you have your tax-deferred with your employer retirement accounts, but you actually start saving retirement assets in after-tax bucket money, because that's going to be the money that can bridge you getting to retirement. That's the big part of it. And then you can focus on the asset allocation, making sure that you're being tax smart with the tax location too.
Because I got to believe it'd be a sick feeling. And we've not seen this in practice, thankfully, but somebody, they start in their 20s. You know what? Okay, I need $2 million. When I get to $2 million, I've calculated that I can retire. And so they save and save and save and save and save and save. And they get to 45 and they got $2 million and it's in their 401k, and they go tell their boss, hey, I'm going to retire. And it's awesome. And then it comes time for them to get their money to pay. And they're like, oh, man, I have to pay income tax on it. Oh, man, I got to pay a penalty. Oh, man, that money is not quite as liquid as you thought it was going to be.
Well, there's always, I don't want to create this fear, because it is an issue, but it gets complicated. That's really the thing is, because I could get you access. If you're retired at 45, you have a 401k that's $2 million. We could get you access penalty-free, but it's just complicated. We have to roll off a portion of the assets into an IRA. We have to annuitize it over your life expectancy.
It's complicated.
It's complicated. So, but it is so. I'd rather you, instead of having to get complicated, we want you to have that simple wealth where it just happens automatically and you don't have to do all kind of unnecessary work. Think about the 3-bucket strategy so you don't have to do all these by last resort planning methods that I have in our toolbox.
So since we're kind of on this idea of early retirement, this next question from Robert is a great one. He said, is the 4% withdrawal rate still valid, or should I be more conservative? I think first we ought to probably define what is the 4% withdrawal rate. When somebody throws that out there, what does that mean?
Well, and I feel like I have to throw a little bit more in there, because sometimes when I just give the advice, people are like, oh, these guys don't know anything. They're idiots. When you see 4% safe withdrawal rate, what has been around forever is the Trinity study. And what this basically said, that if you're 65 years of age, normal retirement, they calculated out that this study was that 4%, pretty much, as long as you weren't pulling more than 4% of your principal asset value, you could make it through about anything over a normal 30-year retirement plan. Well, what's interesting is in the last year and a half, time gets away from me. They've actually come out and updated that. If you have a normal retirement like 65, a historically normal retirement, the Trinity study has actually come back and updated to where instead of 4%, it potentially could be 5%. So that actually goes counter to the question that was asked. But here's the caveat I'll put on that. There's a lot of you folks out there that are part of the FIRE movement. Remember, what FIRE stands for is financial independence, retire early. Now, that retire early is kind of, you guys pick on me about that, because I pick on that one a little bit, because a lot of you guys, I don't know that you really want to retire completely early. You just want to do things on your terms. But it is one of those things where if I think you are now you're leaving your higher paying job to go seek to live life on your terms, you probably, if you're doing that, anybody who's retiring below 65, yes, you have to lower that safe withdrawal rate to the point that we actually use for clients under 50, and Bo, you always do a much better job of kind of putting the where the bands are. But I know if you're under 50 years of age and you're planning on retiring early, you better be using a very conservative safe withdrawal rate. Give them some of the bands we use.
Yeah, some 3.5% if you're going to be in your 40s, certainly in the 3% range. In your 50s, maybe 3.5%. Late 50s, early 60s, we like 4%. 65 and out around that area, you can actually go to 5%. But here's what I think is beautiful: like the withdrawal rate percentage is fantastic when you are far away from retirement to give you an idea. What I actually think is the best fit, and what we do for our clients, is when you get to retirement, it's no longer about the 4% withdrawal rate or the 3%. It's about your custom withdrawal rate based on what your retirement lifestyle is going to look like. Because there are going to be some years you may have a big withdrawal rate because you want to buy a house, or you want to go on certain vacations, or you want to help kids. What you need to do is, before you actually pull the trigger to exit the workforce, you don't just need to say, okay, well, I know that I've got $1 million and I want to do a 4% withdrawal rate, $40,000, I can live on that, I'm good, boom. You don't want to do that. You actually want to forecast out what you think retirement lifestyle will look like, determine what your income need is, and then you have to factor in sources like Social Security, pensions, possibly inheritance, other things that come into play. And your specific retirement scenario should not be boiled down to a simple, oh, I got enough for a 4% withdrawal rate. It should be way more customized than that, and you ought to have stress tested it, running it through Monte Carlo simulations. The withdrawal rate gives you an idea of the number you should shoot for that age at which you want to hit it. But as you get closer and closer to that age, instead of like throwing grenades at that number, you got to get laser precise with what that number is.
Yeah, I look at a safe withdrawal rate as good napkin planning.
Yep.
Meaning that if you're in your 20s, 30s, even 40s, if you're doing traditional retirement dates, there's nothing wrong with using a safe withdrawal rate. But I do think as you quickly approach within the decade of retirement, guys, you better tighten it up, because I tell you all the time, it is a measure twice, cut once, because as growing up in a household with a father who lost his job in his mid-40s, it's hard to lose a good-paying job and think you're going to step right back into a good-paying job once you leave. So you better make sure you're right, and that's why I do like everything Bo said with the Monte Carlo simulations. Get sophisticated with the planning so you know the probability of success, not just some napkin plan that you did off of a safe withdrawal rate.
That's great. This next question is from Stitch Aru. He says, I'm putting 25% of my side gig income into my brokerage account. Should I be going into multiple index funds or just pick one and stick to it? So his question is, should I be trying to spread it out across index funds, or just pick one index fund and go in that direction?
Well, I thought, first of all, switcheroo, right? It was the name? Stitcheroo. Here's the first thing. If it's a side hustle income, make sure you're not leaving some tax savings on there, because, there's the first thing. We've done shows for the tax-favored self-employment savings accounts. I'm talking about the solo 401ks. If you don't want that sophistication, you can do SEP IRAs. There's all kind of cool things. That's the first thing I would tell old Stitch to consider looking into. But then the next question, I think he's overthinking this in a way, and this is why I love what we share on The Money Guy, is that in the past, yes, you could just go buy a total market index fund, and you'd be fine. And that's what there was a period of time where I considered, just for people in their 20s, just tell them do the total market index, and then when you get in your 30s and 40s, then we can do the index target retirement funds. But you have been the one that sobered me up on this, Bo, and the fact that that's just too many moving parts that people can screw up.
That's right.
So here's the solution and what we recommend. Why outsmart yourself when index target retirement funds exist at both Vanguard, Fidelity Investments? These are some of the biggest providers out there for you to go do your own due diligence and research. But they do all this for you. You only have to come up with two things. How much can you save? When do you need the money?
That's right.
They'll do everything else. They take the asset allocation from very aggressive to that glide path of very conservative as you need it. So you just have to focus on making money, and you don't have to worry about, am I getting ripped off? Because they're all buying index funds that are super low cost, super tax efficient, and then you don't have to worry about all the investment things that really distract people from the primary goals.
What I love about this is you basically said yes and both, right? So yeah, there are solutions out there where you only have to buy one fund with your contribution, but because that one fund is an index target retirement fund, it actually is buying a bunch of different indexes.
Exactly
so you're
right.
getting that same diversification benefit, that same auto allocation benefit without having to go pick the ones. You just focus on answering those two big questions and you are set up. So that's a great question. All right, this next one's from David. I'm so nervous to say last names now. So this is one of the 400 Davids out there.
Well, it's, I was
And by
okay
the way,
with
his
last
last
names.
name is Jones. It's an easy one. I
because-
got that one.
Because Stitch, you could have just stopped at Stitch,
I
but
could've
the Stitcheroo
I
kind of
stitched
added a
it,
little
yeah,
element
it
there,
did.
so I was
See?
okay
That's what
with
I was
that.
going for. All right, so he says, do you think it's a good idea to convert some portion of your tax-deferred savings before the expiration of the Trump tax cuts in 2026? So under current legislation, there's going to be some tax adjustments that are going to sunset in 2025. Should I begin doing Roth conversions now because I know that those are going to expire in 2026?
Well, the first thing, Bo, you have a saying, and I love it, so we're going to use it more often on the show now, is your money is not red, your money is not blue, your money's green.
It's green.
So always, because I think everybody has a little bit of a blind spot, especially when it comes to economics, politics. That stuff kind of gets in there and muddies up the water. So we get nervous, and we knew we have a new administration coming in this week, actually. Yep. So people start trying to read the tea leaves to figure out tax policy. I want you guys to hear me out on this. Politicians will say a lot while they're candidates, but once they get into office, they tend to be a lot more in the middle on things because it's just hard to change. It's hard to change this big institution. So I tell everybody, always be careful making decisions off of politics, and not that that's what David was doing, because he had a question there, and I want to make sure we focus. But I think that people need to hear that in this unique time that we're in. But I always tell people, make tax planning decisions off of current legislation. It's just like right now. I know he's currently President-elect Biden, but he'll soon be our president in the next few days. He just came out with a new stimulus proposal. We're not covering that yet because I just know that there will be a lot of back and forth. So I don't think it makes sense to get everything all worked up on it when I know there's going to be a lot of the horse trading and all the other stuff that happens in our political system. But it is one of those things. So I always tell people, with all that set up, focus on the current tax law. Politicians have a tendency to kick the can down the road. So yes, those tax policies are set to expire mid this decade. But will they? It remains to be seen, because a lot of stuff we've seen that they will kick the can down the road. So I get very nervous about people making decisions because of what could happen. Now, Bo, when we were talking, we've had this come up with clients. You had some great insight on what you should actually consider when you're making this type of decision.
Yeah, when it comes to deciding about Roth conversions, you really ought to consider more your personal situation and less about what's going on macroeconomically, because just like Brian said, we don't know what tax policy will be in 2026, but we do know what tax rates are this year, meaning you know what tax rate you're going to be in this present year. So if you are someone in a lower tax bracket and you think that, man, based on the lifestyle that I live and where, I think that rates could be going, not specifically these tax cuts, but where rates could be going and what my lifestyle is going to do, if I think it's likely that the rate I'm in right now is going to be lower than the rate that I'm going to be in the future, whether that be because of increased lifestyle, increased income, or increased taxes, then maybe, yeah, it makes sense for me to begin converting. Or maybe if I'm thinking more about estate planning and passing assets on to my children, maybe I should think about converting. I would let those types of determinations be the thing that cause you to make that decision in the present year, less so than about legislation that may or may not come to pass. So you ought to focus on what's your ultimate estate plan, what are your liquidity needs in retirement, and this is what's beautiful, and this is what we keep counseling clients on. We don't know where taxes are going to go. They could go up, down, left, right, sideways. We have no idea, and we certainly don't know when they're going to do that. So what we try to do is we have our clients focus on building these 3 distinct tax buckets: your tax-deferred bucket, your tax-free bucket, and your after-tax bucket. If you can do that effectively, when you get to retirement, no matter what the tax policy is at that time, you can pick and choose what you pay in taxes. Perhaps it's a high tax environment, so you're just going to pull the taxable stuff for the low amounts, and then you're going to pull the tax-free stuff and then the after-tax stuff. Or maybe we're in really low tax rates, so you're going to pull more of the taxable stuff out and less of the tax-free. If you have those 3 distinct buckets, you're going to get to pick and choose, and odds are, over a 20, 30, 40-year retirement, tax policy is going to change, and so your strategy also will need to adjust in real time as that happens.
Yeah, I think it's one of those things when we're working on this, we actually give numbers to this, is that we say, first of all, if you're below 25% combined tax rates, and when I say combined, I'm talking about both your federal and your state income tax. Yeah, I mean, Roth accounts make sense. And doing a Roth conversion probably does make a lot of sense. That 25 to 30% is kind of what we consider the gray zone. And then once your income tax rates are over 30%, you ought to consider, are there some benefits to taking the tax deferred, meaning taking a current year tax deduction? Now, here's the part about this. The whole logic behind what I just told you is because for a lot of folks, you may pay the highest taxes while you're earning money, while you're in your peak earning years. And then when you retire, especially if you're doing the 3-bucket strategy Bo talked about, you can manipulate legally your tax rates that you pay, and you're hoping that your tax rates are a lot lower. Now, if you're a glass half full on tax policy and you think rates are going to be substantially higher than they currently are, then maybe you can. I'll give you permission to, instead of 30% being your combined rate that you consider, maybe you can push that up to 35%. That's going to be more of your personal decision. I still think that you probably first, because there's 2 big questions. What's your income going to look like in retirement? Can you manipulate the tax code legally? And then second, what's your thoughts towards tax policy in the future? If you're very confident they're going to be substantially higher, then I give you permission to kind of push up a little higher on what is that Roth conversion threshold.
Again, it's a very individualized, personalized decision. And frankly, this is one of those that's a little more complicated. It's gotten more complicated over the years, even in terms of your ability to undo it or not undo it. So if you are thinking about those things, this is probably one of those great points in time where it makes sense to reach out to a professional advisor, to reach out to a tax advisor, to make sure you're making the decision well and not thinking about the unintended consequences.
Yeah, no doubt.
All right, so here, let's do one more. This is from that dude, and he says, when you say save 20%, do you include the X percent your company is putting into your 401k? For example, if your company puts in 5% and I put in 15%, is that good?
Yeah.
Let me answer the last part
Go
first.
ahead.
Is that good? Yes, it's awesome. If you said, hey, I'm only putting in 1% and said, is that good? My answer, yes, that's awesome. The fact that you're saving and even grasping deferred gratification is wonderful, and I want all my young folks to hear that. We say all the time, save 20, save 25%. Don't let that be something that demotivates you because you can't do that. If all you can save is 1%, great, do that. Figure out how you can turn that 1 to 2, that 2 to 4, that 4 to 6. Figure out how you can grow it. But if you're just saving at all, that's great. Now, if you want to move into sort of that financial mutant territory, you are exactly right. Our goal is that we want you saving 15 to 20% of your gross income. And if you want to know why, go to our website, go to moneyguide.com/resources, and look at our illustration called How Powerful Are Your Dollars? And we show you at every age, starting at 0 all the way out until 65, how valuable every dollar you can put away is. So the earlier you can start putting away that 20 to 25%, the more powerful those dollars are going to be as you move towards financial independence.
Yeah, and what I'll add to that is that people know we have a system on this too, and I love creating systems so you guys can make decisions and feel confident about it. And I always like people to understand the why of things. Is that because I had somebody just recently on the comment section go, "What do you guys consider wealthy?"
Sure.
I'll never really answer that question because it's so individualized to every single person. Because having a retirement savings of $400,000 makes you wealthy if you're somebody who's not spending. Maybe you only made $45,000, $50,000 a year, and you got a pension coming your way at retirement and Social Security. Isn't that going to require much for you to be wealthy? So you can do it. So that's why what's gone into our design is that this is what I'll tell people for the rule. If you as a single person make $100,000, or as a household, meaning you have a spouse, $200,000, I don't want you counting the employer match. And the reason is because of exactly the example I just shared, is that the lower your income, the closer you are to the social safety net. You probably have, if you're only spending $35,000 a year, Social Security is going to cover probably 2/3 of that. I mean, it's going to cover most of it. So you're not really asking much of your assets to make sure you have a good, sustainable retirement. The higher your income, the higher your likely expenses are in retirement. You better make sure that you're bearing that weight responsibly.
Right.
So I do put on top of you that if you're making good income, like for a married couple making greater than $200,000, don't count that employer match, because that is something you're going to bear the cost of having to pay for that retirement primarily. Social safety net might not even be there for you. So act accordingly. And that's kind of the way we've designed this. Like I said, if you're a lower income individual, you can make a lot with a little, but the more you're entrusted with, the more you earn, the more you spend. You've got to plan for that. And unfortunately, that means you got to be even more conservative on the way you look at your savings rate, on what you count and don't count.
That's exactly right. Man, these questions were fantastic. Thank you guys again for letting us come in, hopefully add value to your financial lives. If you've not had a chance to go check out our websites, go check out moneyguide.com. You can go to our resource page. We have all kinds of free deliverables out there, mortgage calculators and tax guides and powerful numbers. All of those things are on the resource page. So if you've not checked that out, check it out. Or if you want to know a little bit more about what we do in our day job, go to our website, aboundwealth.com, and you can see all the folks that you'll get to meet when you come to Franklin to do your tour of the studio.
Hey, and we're investing in you guys, so I'd ask you to invest in us by giving us a like as well as a subscribe. Right there, you can see we're already over 102,000. Man, it just seems like yesterday we were at 100,000. So thank you, thank you, thank you. The abundance cycle seems to still be working. We love you guys, and we're going to keep coming back every week, every day. I mean, it seems like now it's about to be 2 times a day. So thanks so much, guys. Money Guy team, out.